welcome back, everyone. Next, we have Pure Cycle Corporation. It trades on the NASDAQ under the symbol PCYO and is a diversified land and water resource development company who possesses a lucrative portfolio of land and water rights in the fastest growing sector in the Denver metropolitan area. Please welcome its president, Mark Harding. Welcome back, Mark.
Thank you. And so this is my first opportunity to introduce Pure Cycle to the Emerging Growth Conference audience. And so I'm excited to be here. And thank you, Anna, for the opportunity. What I'd like to do is I'll run through the presentation. This is kind of an adaptation to our Q3 earnings call. So you'll get a little bit of an understanding of the various segments that the company operates in, as well as some of the performance up through Q3 for our fiscal year end. We have one of those odd fiscal year ends. We have an 8/31 fiscal year end. So we're actually just approaching our fiscal year end. So it's a busy time activity for us here at the company. So with that, I'll start the slide deck for all of you that are viewing this live. First slide is always our forward-looking statements, which we want to get the lawyers out of the room by saying that these facts that are contained or incorporated by reference in this may be forward-looking statements within the meanings of the SEC Section 27. I think you're all pretty familiar with the forward-looking statements. So what I'll do is I'll briefly give you a Q3 results. But before I do some of that, what we want to do is really talk a little bit about our strategies, some of the management team and our performance, the asset trajectories and how we really monetize our assets, and then a little bit more about kind of updates that the company has coming up. As kind of what Anna introduced us to, we are kind of an asset management company. We operate in the Denver metropolitan area, and our leadership team really is a very experienced team of professionals. We have a very strong, a very heavy board for a company our size that really give us a tremendous amount of industry experience. We'll talk a little bit about that team later in the presentation. The complementary segments that we have. So we have three different business segments. We operate in the water utility, the land development, and then single family rental segments. And a little bit about our investments and the asset portfolio as a whole. So the management team is myself. I've been here about 34 years, so it's been the bulk of my career. Really started out when the company was just formulating itself and really been responsible for the acquisition of most of the assets. But the rest of the key senior management team are Mark Spezialy, who brings a couple decades worth of financial expertise as our CFO, Scott Lehman, who really has almost over 40 years of water and wastewater engineering experience, and Dirk Lashnitz, who handles up our land development segment as well. So strong, very seasoned leadership team who've been with the company for a number of years. So to introduce you to really what we do, we operate in three complementary business segments, water and wastewater. We operate here in Colorado where you can own water, and that's a little bit unique for companies. We're a investor-owned, privately held water utility company, and we do everything from cradle to grave, where we own the water rights themselves in an area where you can actually own physical water rights. Here in Colorado and much throughout the West, they're really a severable property interest, and you can obtain title insurance. They're a separate deeded instrument that companies or individuals can own in the Western United States. And much like what you've heard, there's always a scarcity shortage of that water supply. And Denver is a little bit unique in that because much different than what you would see on a coastal area. We just simply don't have the option to create a supply by desalination. So we are very dependent on that existing portfolio of water, how that's managed. And I'll talk a little bit about that. We have what I would say is a very large portfolio. We own about 30,000 acre feet of water. And how we translate that is that we can serve up to 60,000 single family equivalent homes with that. And we gauge our unit of service as an SFE, a single family equivalency. In addition to the water utility enterprise, we are a land developer. So we are a developer of master plan communities. We have a current master plan that includes over 3,300 single family or 3,200 single family residential units and a little over 2 million square feet of commercial retail and industrial uses, which again, we convert that over to a single family residential that adds to about another 1,800 both lots as well as water connections within that portfolio. So there's about 5,000 connections worth of land development opportunities that we control on the very attractive I-70 corridor here in the Denver metropolitan area. And then lastly, and this has been more of a recent segment to the company, is that we keep a portion of the lots that we develop instead of transferring them to our home builders. And we partner with our home builders to build us homes on those lots we keep for our own portfolio. And we keep that in our portfolio for a single family rental home segment of what we're doing here. So you see a little bit of vertical integration within all of those. As we talked a little bit about the asset portfolio, water, wastewater, we'll talk a little bit about that, but about $64 million in total water assets in that portfolio, a little over $10 million in the land development portfolio. And then really just starting out, we've got a little over $5 million in our single family rental portfolio. We have about 14 homes that are currently constructed and currently under lease. What you'll see as you dig into the balance sheet and dig into the financial statements are we're very liquid company. We have a very strong balance sheet, very little debt. We have about $57 million in total liquidity between our cash and cash equivalents, as well as our note receivable. And our note receivable is that note receivable that we get from our land development activities, where we develop public improvements, and then we get repaid for those public improvements as we transfer those over to the governmental entities that operate and maintain those. And so you see a really strong balance sheet, very little debt. Some of the debt that we do hold really is debt attributable to the single family rentals and allow us to go vertical with those with a little bit of leverage. And we have about a 60% loan to value ratio because of keeping the equity value that we have in the horizontal infrastructure, the roads, curbs, and gutters in our balance sheet, and then just going vertical with the home itself. And we partner with our home builders to do that. I want to talk a little bit about kind of our financial performance of our Q3, just to give you a sense of kind of what we're seeing on a quarter over quarter basis, and then how we'll roll into year end. This last third quarter, we had terrific revenues, about $16 million in cumulative revenues, and gross profit of right around $10 million. You can dig into that a little bit more on the financial statements themselves. Taking a look at net income and earnings per share, again, we're putting up some terrific numbers and really just starting to monetize these assets, which we'll talk a little bit about. But when you look at really the momentum of the company, we have got a tremendous momentum going behind bringing these assets to market and really taking what have been legacy assets, where we acquired some of these water assets as far as 30 years ago and have very low basis in them, and really starting to see them perform and really bring value to shareholders. A little bit about our margins. These are going to be pretty attractive margins in all three segments that we have. We have gross margins in our water segment of around 53%, our land development close to 70%, and then margins in our single family rentals around 55%. So as you start to see some of the individual segments, you'll understand kind of why we have such high performing segments. And it really is because of our cost basis in all of these assets and the attractiveness of how we're developing them. Let me drill down a little bit in the water segment. As I mentioned, we've got a very large portfolio of water in the West, which is a hard thing to accumulate. Water out West is a very complicated formula. You typically acquire water interests from agricultural interests. The company has been acquiring this portfolio of water over a number of years, and we monetize that through two mechanisms of that. One is where we get a very large upfront fee, which is a tap fee, which really relates to system development fees. And our tap fees now, our combined water and wastewater tap fees, are about $40,000 per connection. And so when you take a look at applying that to our overall portfolio, we can serve 60,000 connections. And that's a gigantic number, right? It's $2.4 billion worth of top line revenue potential. And we're just getting started to monetize those. And really, this shows our performance in the tap fees over the quarters that we have, the Q3 cumulative quarters over the last 3 years. And then also, once we've got that connection, we get water usage revenues, what you normally see as your water and your wastewater bills that you come on a monthly basis. And we generate about $1,500 per connection per year on an ongoing basis as we connect those up. And so this shows you a little, excuse me, a little bit of migration of our customer accounts. We've grown to about 1,600 customer accounts over the last 5 years. So we've got a real significant growth of the number of connections that we're doing. And we're really just getting started if we're looking at the total capacity of the portfolio. Taking a look at, we also provide water to oil and gas customers. So it's not just our domestic customers. We provide water to fracking operations, which happen to be located right on top of where some of our activity is. So the real advantage for us is our water supplies are located very close to where we're using that water supply. And when we sell water to oil and gas companies, they do pay to be at your beck and call. They pay very well for that sort of thing. And they use a lot of water. And it's interesting because there's usually a very significant conflict on water providers, existing government water providers providing water to oil and gas, mostly because it's at somebody else's expense. And because we have a very large unallocated portfolio, we're one of those entities that's a very synergistic relationship between oil and gas and water utilities. Each well that we frack generates in excess of $250,000 worth of water sales, and that can occur in roughly 2 weeks period of time. And really, that's the equivalent of us serving over 200 single-family homes for a year. And so it is a very large and very attractive customer for us. Talk a little bit about some of our land development segments. This is a bit of a Q3 performance on our land development segment. We're, as I mentioned, we have about 3,200, a master plan community that includes about 3,200 single family residences. And this really illustrates the performance that we've got to date. Our first phase of that was about 509 lots. And we kept 4 lots of, as you can see, our SFR lots there. So we had 505 for sale lots and 4 SFRs that we kept. That's 100% complete. Our phase 2, which has 4 sub phases. So 2A, we had about 229 lots. We kept 10. So we sold 219. That's also 100% complete. We just opened up phase 2B, which is about another 215 lots. We kept about 17 lots and we're starting construction on that. We've delivered all those finished lots. So we've got builders pouring their foundations now and getting active on that. And then we've opened up 2 more phases, 2C and 2D. We're in the grading phase, or I'm sorry, the utility phase of phase 2C, and then we're looking to start grading on phase 2D sometime in the first quarter of our next fiscal year, or call it fourth quarter this year of our calendar year. I can give you kind of a visual image of that. This is going to be what you typically see, a master plan community. We've got some of the mature phases. This is phase 2A, which is fully complete, and then 2B, where you can see all the finished lots available, and then 2C, where the grading was done, and then continuing on to 2D. As you guys, I'm sure, are monitoring kind of interest rates and the housing market in general, we're one of those companies that really will benefit from a lot of the interest rate tweaks. If you take a look at the Denver market is an extremely attractive market. But one of the things that we suffer from is kind of affordability, as most metropolitan markets see. But I would say that the Sky Ranch project, being on the interstate I-70, is one of the most attractive and the most affordable master plan communities currently under development in the Denver area. And our segmentation here is we're really an entry-level product here. The terrific detached single-family homes, and really with price points where you can buy a home starting less than, with a number that starts with a 4 instead of a 7 or 8. The average sale price in the Denver metropolitan area is now close to $600,000. And so, it puts our lots and our homes in high demand. So you'll see what we're seeing with an acceleration of our lots is really a function of that price point, that entry-level price point. This will really kind of outline some of our single-family rental growth over the most recent quarters. We've got about a 30% CAGR growth in revenues on that. Really 14 rented homes, but this portfolio will grow within the Sky Ranch Master Plan community to over 200 units. So it will become a very significant component of that. And it's really a nice tax advantage way for us to continue to build on the equity that we have, not only from delivering the water utilities, but then also the single family lots that we have under construction for our home builders. This will be a kind of a slice of how that kind of accelerates over the first phase, the second phase where we added another 10 homes, then continuing to grow in the next phase of 17, 40, and then continuing up through that. So this will, when we get done with our second phase, which will be really within the next 24 months, we'll have about a little over 90 single family rental homes, really providing that cash flow to our sustained operations. This is kind of how we see that income growth as well as the fair market value growth. So you've got the rental income that keeps growing, really generates positive cash flows to the company, mostly because we carry forward the equity from the water utilities as well as the horizontal infrastructure on that. So nice segment for us. We're very pleased with the performance of this segment. I did introduce a little bit earlier on kind of a discussion about our portfolio utilization and give you kind of some capacities that we have. And so this will highlight the highly appreciated nature of these assets and how they're really just starting to generate the monetization. Talk a little bit about the real estate market. As I was highlighting a little bit earlier, we really have a shortage of available lots, and those are really a function of kind of interest rate locks from the existing home market, where sellers are really reluctant to turn in a 3% mortgage for a 6-7% mortgage. So that really cuts down on the resale market. And then just bringing lots to market, bringing raw lots to market is a complex process in any market. Denver's no different than the other markets, but we're one of the few that are out there in the business of developing finished lots for home builders. And that's something that they like. Most markets, they are compelled to have to do that themselves, and they prefer not to be in that business. And so we're a good partner with them and delivering those finished lots for them. So as I mentioned, kind of the vertical integration of each of these segments. What's attractive about our water segment is really the size of the portfolio, being able to deliver 60,000 connections worth. Taking a look at our land development segment, we have about 3,200 residential lots with another 1,800 commercial lots, and we're just about 15% complete on that. So we've got a lot of pedal left on that. And then again, still early on our single family rentals, where we've got 14 units through a planned couple hundred units within the master plan development that we're developing. So our water capacity, this is kind of an illustration where we can supply the amount of water that we can supply in any given year. So these metrics are, we in the water system metric it by something known as an acre foot, which is literally 1 acre, 1 foot deep. And it's a capacity issue. And so we're delivering water to oil and gas customers as well as our domestic residential customers. And we've got about another 50% of capacity that's currently developed. And what that translates into is margins, where we have existing equity into our system. And so as we continue to grow that revenue base, we've got, the capacity for almost doubling that from our current capacity. As I was mentioning, the tap fees, taking a look at where our current tap fees are, that generates about $2.4 billion worth of revenue. It costs us about 50%, a little bit less than 50%. It'd be about $1 billion to fully build out that system. And that system includes, reservoirs, water treatment facilities, wastewater processing facilities. We currently have 2 wastewater treatment facilities. One of them is a state-of-the-art facility, which is for all those that are kind of familiar with the Western world, we reuse and reuse every drop of water that we can. And so this is a zero discharge plant where we recycle and reuse 100% of the water that comes out of that plant. And we really reuse that for oil and gas demand. So that's a very attractive thing. But we're just getting started on this portfolio allocation. And so you'll continue to see terrific margins attributable to that. And this is kind of the land capacity, where we have capacity both in terms of the residential side. So as we take a look at the 3,200 units, we're about 37% built out there. Have yet to get started on our most valuable real estate, which will be our commercial real estate. And then if you take a look at those combined, that'd be just about that 15% that I was mentioning. If you look at that, we have a book value in our land. And really, we bought this land at the height of the Great Recession in 2010, really when nobody wanted raw land. And so our land basis in that, if you take a look at the balance sheet, is only about $4.5 million. And when you start to attribute how this will build out over time, we have more than $600 million worth of revenue margins in developing those lots. So we've got tremendous value enhancement holding that land for the last 14 years. So that's going to continue to really roll through to the balance sheet and the income statement. Single family rentals, a little bit, we're producing revenue from 14 units. So we'll continue to expand that portfolio. Kind of gives you a size of where we're at now in terms of the number of units, where we're headed, and then kind of the revenue potential for each of those segments. So key takeaways. I talked a little bit about our great margins. The overall blended margin for our assets is around 62%. Return on assets about 8.5, and then our continued asset growth here close to 10%. And really, this margin opportunity is because of the cost basis. We have a very low cost basis in how we're doing that. The return on assets, what we have been able to do is invest in a lot of that excess capacity. And so you have a tremendous opportunity for us as we start to use that excess capacity that continues to improve that return on asset. So you continue to see those increase as we continue to develop more of that. Some other updates, there's probably not a management team that you're going to hear from that doesn't believe their stock is undervalued, and we really do. It's one of those things where, the company's really just a young company in terms of its development. We've been around for a long time. We've held these assets for a long time. But in terms of really just coming into generating returns from these assets, we're really starting to do great things on that. And so the market's just starting to get an appreciation for what it is that we do. But to the extent that they don't, we certainly believe in our own balance sheet and our own income statement. So we tend to have a very direct program to continue to reinvest in ourselves on that side. And then this is kind of a little bit of the repurchases that we've had over the last few quarters. So that'll give you a sense of that reinvestment. And then this is just kind of the profile of the board of directors. So you can certainly go to our website, and there's a tremendous amount of information there at purecyclewater.com. And that'll give you a better sense of kind of some of the things that we're working on. So with that, I'm going to turn it back over to Anna and maybe see if those that are listening want to drill down on any of the specifics that I've covered, or if I went through it too fast. Certainly happy to slow it down and really kind of re-familiarize yourself with it.
All right, great job. We do have some questions for you in a little bit of time. Jonas asks, because you're a utility in certain areas, do you have a competition out there?
Good question. I would say we are really the only private company that is providing water and wastewater service in the Denver metro area. If you take a look at that across the United States, about 15% of water in the United States is provided by private companies like us. There are some companies that are much, much larger, usually on each coast, the East Coast and the West Coast, but bigger names on that are Aqua America or American Water. Some of the ones on the West Coast, there's San Jose Water, or if you're along the East Coast, you probably in Pennsylvania, you would have heard of York Water and some of the others that do that. But Colorado, really, we're the only one that does this privately. Every other water provider is a government water provider. It's a city, it's a municipality. And so those are, you don't get service from them unless you annex and incorporate within the city. But we have our own franchise service area that allows us to provide service exclusively to properties that are in unincorporated areas.
Thank you for that. Roy Hines asks, what are some of the risks of your business? Are there any local political risks, drought risks, anything else that's a risk?
Yep, those are going to be very typical risks. Drought risks are always going to be out there. If you take a look at the water supply segment that we have, and what we do to mitigate some of those risks are we have kind of a blended portfolio of water. And in Colorado, Mother Nature's great. She stores our water for us for 6 months of the year in terms of the snowpack, but she has a sense of humor because she gives it to us in 45 days. And that's usually before our demand kicks in. So with that spring runoff, you kind of have to divert that water and be able to store that in reservoirs. And then to the extent that you have a low snowpack, we rely on the aquifer. So we have deep aquifer water that's there year in and year out. And so in wet years, when we have a high snowpack, we take and divert that and we put that water back into the aquifer and use that for an aquifer storage and recovery. In dry years, we pull that back out and we use that. And then seasonally within the year, we take water when it's available in the spring, we store that in reservoirs, and then we use that throughout the irrigation season over the summer. Some of the political risks in the land development business, you're really dealing with governmental agencies, right? You've got the entitlement agencies, whether that's going to, in our particular case, we are in an unincorporated area, so we work with the county. Our local county, Arapahoe County, very pro-business county. They very much appreciate what we do because we generate revenues through their tax base. And so we put up a good product. We have great open spaces. We have great care in the development of our community. We built our own charter school so that we're handling an on-site K-12 campus for the folks that are going to be living at Sky Ranch. And so you really do have a partnership on being able to develop as a master plan community, and they ultimately take over the role and responsibility for some of that transportation infrastructure. But the biggest key risks really are not necessarily whether or not these assets will continue to generate, but a timing element of those. And Denver, fortunately, has been one of those markets that have been very attractive in terms of in-migration. So we continue to get, almost 2 times the number of people that are moving into the state as opposed to our organic growth on births. So it continues to have a great economy. For those that have been here, you understand that. We'll beg for forgiveness on our Denver Broncos and our Colorado Rockies. They don't inspire people to be coming to the state for those. But the Colorado Avalanche seem to have a way, and the Nuggets have a way to find their way to a national championship.
Absolutely. It's a growing market for sure. Carly Black asks, how do you grow? Is it a simple matter of acquiring and land banking, or what other regions might you get into?
That's a great question. What we do on the asset acquisition side is our primary interest for acquisitions is going to be for land acquisitions that do not have water. And the interesting metric here is we can acquire a land interest without water, knowing that we have water to bring to that land interest. And really, the water is almost 3 times the value of the land asset. And by that, I say, let's say we acquire a land interest for $20,000 an acre that would be in the metropolitan area, but would not be able to develop because it doesn't have water. When we add our water to it, that land value, just the coupling of our water interest alone, brings that asset value up to like $60,000 an acre. So it's a tremendous opportunity for us to use our portfolio and vertically integrate ourselves with those land acquisitions. And then we continue to add to our water portfolio. We have a sizable water portfolio, so we're fairly picky about where we want to add our water, and it has to be strategically located to where our supplies or our infrastructure are being developed. So that's how we kind of grow those 2 portfolios.
Well, perfect, Mark. Thank you so much. Do you have any closing remarks for our viewers today?
No, if there was something that intrigued you, certainly don't hesitate to reach out and give me a call. Happy to drill down on some of the specifics as you learn a little bit more. And again, don't hesitate to drop in on our website. There's a ton of information there for you to the extent that I went over something too quickly or that you want to get a little bit more information on. So thank you for the opportunity.
Perfect. Thank you so much. We'll look forward to having you back in the future.
Great. Thanks, Anna.
All right, everyone, stay with us. We'll be right back.